go.
Let's go.
Happy Tuesday, everybody. My name is Andy Elliott. I'm a realtor here in Williamson County, Tennessee. Oh, and hang on, we got to do something already. Got to take care at Williamson County, Tennessee. And I'm talking to my best buddy, Rodney Wilds, who is a lender here also in Williamson County, Tennessee. On this live stream, what we try to do is just converse about what some things local, some things national, and topical information for you. And if you have questions, just reach out. Our telephone number and all the text information is available. Hi, Rodney.
How are you doing, sir?
You know, I am pumped about today. I'm excited about today's topics.
Nice. We got some good stuff today. It's going to be a good show.
Yeah. I mean, I get to do my favorite thing, which is pick the brain of a lender, because I'm telling everybody out there, Rodney is so smart and he thinks outside the box and he gets things done. He's a great partner.
That's nice
really,
of you to
really
say.
is. Yeah.
I'll pay you later.
Yeah, right. Yeah, absolutely not. So, are you ready for Christmas?
You know, I'm not, but as my kids get older, it means less and less about all the presents and stuff and more about just hanging out. So, you know, I guess from that perspective, we're ready, but I haven't got all my shopping done.
Yeah, I'm to the point now. I just text my daughter, "Hey, it's Christmas. What do you guys want?" You know, and it's all Amazon. So
yeah, see, I can't get a list from my two. They're you know, they're not really big gift people. You know, my two boys, they're really not big gift. You know,
yeah. So yeah.
I'll have to scratch up something for them though.
Yeah, well, it's fine. So, we were just talking about a couple of things, Rodney and I were, before we got online, and I'll just put this out there. If you're listening to this after we get done, because that's where we get most of our views come after we button up the show, because it's Tuesday, 1:00. There's a lot of people working out there. I get that. But we were talking about New Year's resolutions. And as we turn the corner, you know, a lot of people, including myself, kind of hibernate just a little bit in late December, because that's what we do. But then we come into January and it's going to be like New Year's resolutions and stuff like that. If you can leave a comment on what is it that you're going to be making a resolution for in terms of housing, lending and housing, wherever you are, Nashville or national, what's the resolutions that you're going to be working on this next January? I'd be really interested if you could add that. That'd be great. So
yeah, I need some advice. I may pick up some tips too.
Absolutely. Well, we're going to start where we always start, and that is going to be, it's been a wild ride on rates. So Rodney's rates, here we come. I'm going to have to bust out my guitar one of these days.
I don't know. We might go from one viewer to zero. Just
okay.
All right. Hey, we're still on a nice trend. If we want to look at today, we're up just 8 basis points from today, which anything green is good, meaning when we go up in pricing, your rates are going down. We're going up on, you see here, the mortgage-backed security note at 6.5%. It's now paying us 101.87, and that's up 8 basis points. So as it goes up and we collect more money on that, it means you get a lower rate, right? So that's how that works. If let's see here, go down a little bit where we can see the monthly change. This is a 6-month look. We are tracking very nicely coming back from October, mid to late October. And we got, let's see here again, it's from the lowest levels, 98.6 to 100. So that's about 310 basis points right there. Just kind of over a a little over a month.
God, man.
Um, so that's a great climb. That climb right there is a very significant decrease in rates in a short period of time. So with the Feds doing what they think, and everything's tracking, inflation's coming down a little bit. The job market's not crazy hot. This is allowing us to everybody projecting for a soft landing and no recession, or a small recession if there is, and it's tracking that way.
That's excellent news. I mean, it has been a ride. It had been like I'm pretty sure it's 3/4 of a point in the last couple of weeks, right?
Yes, when it's 300 basis points, or it was like 98.5 to what I'm seeing is one, just basically to 102. That's 250 basis points. Um, it's significant. It's like that's taking it from 7.25, or 7.5 to 6.75, something like that.
Jesus.
It's really, really nice.
And do you expect? I'll bet you expect more applicant when it comes down like this and then settles. Because I think that I've struck on what I'm going to call a standard term for me, is that when we have rates that are vacillating a little bit, like they have been, and they've been kind of rock and roll. We could do the roller coaster, we could. But when they've been vacillating, when things start to settle down and be a longer duration, is that when you see more like applications start flowing? Is that typically the way that works?
Yeah, if any other time but December, like this started. It took a big, like the 1st of November, and then November 14th, and then November 27th. So if we wasn't right around in late November or December like this, I would expect more applications. Now, applications are down because it's still high and it's December, right?
Right.
So a lot of stuff cools off due to right now all the market conditions is contributing. But in a different world, if we'd seen this kind of rate decrease, it would have definitely picked up applications a lot more than it has right now.
It would. I see that it would have just exploded, because it seems to me, and I think that it's fair and it's human nature, that there's been so much vacillation, oscillation, whatever you want to call it. We're sitting back waiting to kind of see what's going to happen a little bit.
Sure, just them being so high produces so much uneasiness in the customers and consumer confidence and things like that. Anytime it starts going down, it's going to give it and it, for the longer the duration, the confidence will get better for the consumers. But when you go from 8 to 7, you're not going to dominate. It's not going to go crazy and pick up applications, because 8% was at zero, right?
Right.
And we've already been at 7 a couple different times during the year, and 7 was still problematic as far as applications. So although it's helped, it hasn't helped as much because where it's coming from and the time of the year.
Yeah, yeah. And I, you know what? And even though the market has been uncommon this last couple of years in particular, because I mean, if you remember last year, we really didn't have the normal winter season. We didn't have that normal. It slowed down some, but not like usual. Well, this year it's crickets. I mean, this is a different thing. So that's good information. Well, it seems, and then, well, we're going to talk about more about that in a minute, about the Federal Reserve could achieve that soft landing after all. We'll talk about that in just a minute. But first, at the top of the show, what I wanted to be able to do, and if you have a question, pop it on the chat, and I'll enter that. Rodney and I can see it. But I wanted to pick Rodney's brain on some of these lending questions. For example, here's the first one. Can you explain the process and benefits of refinancing a mortgage? And the second part to follow up to that is, when is the best time for a homeowner to consider that refinancing? Because we've been hearing that for almost a year now, right?
Yes.
Buy
Yes.
now at a high rate, you can refinance later.
All right. When's time to refinance? And that is a huge individual question. A lot of it depends on your goals of refinancing, right? If your goal is to reduce your monthly payment by X dollars, or else it's not going to be worth it, then basically that's simple. That's a simple math equation. It's like, when do the rates get down enough to save you enough money to where you feel like personally it's worth? I will say this. I think, one thing I like to do when I'm doing a refinance is that although the closing costs are typically rolled into the loan, right? Usually what happens is the customer can come in not paying any money out of pocket, roll the closing cost in, skip a month's payment, and go on about their business in a typical refinance situation. Now, just because it's rolled in, I think it's very important that you look at that dollars and say, okay, I'm eating up this equity. You need to treat it just like you're bringing that cash to closing, although you're not.
Mm-hmm.
And then really take into consideration how much it's saving you versus that cost. Like how much time has to pass of you saving that per month to make up the cost situation, the amount that you've rolled into the loan. So that's the first thing, is because people think that you can do it like a quarter, 0.3%, 0.5%. But if your loan amount's low, it may take 2%, for you to make up enough money. But if you got a $700,000 loan, it may only take 0.75% for it to knock down a good significant amount of money.
Mm-hmm.
So
Mm-hmm.
that's the timing of it.
And you're talking about basically breaking even somehow with the closing cost expense, right?
Right. Yeah.
Yeah. Okay.
The number one thing I would recommend, one, is that we're always going to look at cost to make sure it's worth it. Right.
Mm-hmm. Mm-hmm.
And the second thing I always recommend is, if you can reduce that term at all, it makes the refinance a lot more viable to you, because you're paying off the loan so much quicker.
Right.
Like if you started out with a 30 loan, and then 2 years later rates dropped significantly where it made a good thing, my first thing I'm going to say, hey, would you look at a 25-year loan and then kind of show them the amortization on that 30-year loan? Because it's terrible on a 30-year loan. Like, you pay $3,000 in interest and $200 goes towards your principal.
Right.
So I'm like, let's not try to ever repeat the first few years of a 30-year mortgage. Okay. And that's about the timing question of the mortgage, of a refinance.
Got it.
If that helps. That's probably too long-winded.
No, but I think that probably the first thing you said is, it's truly a personal case-by-case basis for any individual, not only with what it cost them, but what their position is. I mean, I guess what I'm saying is, it would probably be wise to talk to somebody like yourself, and that sounds like I'm pandering. I'm not. In order to make a decision like that, you need to have somebody that knows what's going on and the effect it'll have, right?
Yes, we have, like, I have a bunch of different calculators. Let me see here if I can pull any of them up. Well, I can't pull them up while I'm on this, but you have calculators like cost to wait. Like, if if you're considering it now, how much does it cost you to wait to do it? Factors that, like, if you did it right now, what does it look like? And things like that. We run those and just look at it and say, and it's easy because people there are their best financial advisor. And if I can say, look, this is saving you, $300 a month, but it takes you 8 years to make this back. And you're like, well, I'm not going to be there 8 years. I'm like, well, hey, don't buy into this trap. All your neighbors are refinancing. It just doesn't mean you need to. right?
Yeah,
Because your
yeah.
plan is not the same as everybody else's plan. So that's what you look at. You just kind of get it individually and don't always fall for the lower rate.
That is really an excellent point. I tell you, if you'll do me the favor, Rodney, send me an email with those different calculators you got, and I'll publish those in the comments. And if somebody wants you to run those for them, I'll leave your information in those calculator things
Got
there on the comments. I'll do that.
Yeah. We probably won't get a lot of comments on a refinance calculator right now because the rates are so high, but we'll we'll put them all in there in case you do want one.
Well, that's what I'm saying. I mean, you got to have a number of them. So,
Yeah.
so the next question. Now, this is just because of sometimes the questions that I'm asking aren't necessarily for me personally, but what happens in the real estate business is I run across these scenarios for my buyers regularly during the course of the year and over the years. So here's one that I get asked a lot. And it is, how does a person's credit score affect their mortgage options and interest rates? And to follow up on that, what steps can potential buyers take to improve their credit score before applying for a mortgage? And I'm going to ask you a third question. I don't expect you to remember it is should they try to improve their credit score before they apply? 3 questions.
All right. So should they try to improve, and what effect does it have?
Yes.
All right. The credit. If you've seen some of our earlier podcasts when we talk about like the number one thing you need to do when you're going and buy a loan is to make sure your credit is good. Make sure your credit is the best it can be. Like if it's around whatever it is, like you just got to make sure there's nothing on there or whatever. It's the best it can be. So absolutely, you need to have your credit looked at. It is probably by far the most determining factor of your rate. And it's gotten that way. Even our in last year before, when they come out with a new loan level pricing adjustments,
right?
They even created new sections for a 780 score. It used to top out, like if you was at 740, Fannie Mae didn't give you any more good or bad after that. But they've created a 760 bucket and a 780 on top of a 740. So credit has never been more important. You need to look at it immediately, and then you need to do everything you can to get it up if you have time to before the purchase, which we do that all the time. It's fairly easy.
And is that something that you can look at with people to help them decide what to do?
Typically, yes. Typically, what happens, and most all lenders have this. Like when they apply, when I see the credit report, it'll tell me if I've got, like it's going to give me what their score is, but it's going to give me a potential score as well. And then the details is a little hyperlink out next to that says, if you click on it, it'll say, okay, if you do this, this, and this, you can improve your score by 20 points or whatever.
Oh, okay.
And so, yes, if it's an opportunity there, we can print that out, give it to them, and say, follow this to the letter of the law. And then we have it set up with certain parameters. Like we're not going to ask the customer to spend $20,000 to improve their score. So I think in the system, it may be like $2,000 or $4,000 that we say they have disposable of this to fix their credit if needed. And sometimes it's not even about money. It's just about either lowering a balance or something. I mean, it's
right. And sometimes things happen that only time can heal it too, right?
Yes. Oh, absolutely.
I mean, there's just some things that.
But we look at it. I mean, that's probably the number one thing they need to look at going into a new transaction. If they know their credit's good and they never miss a payment, they really don't have to worry about it. They're just like, hey, let's get it done in the pre-approval process.
Got it. And then what's going to blend into into that question is we're talking about credit score and mortgage options. So what unique challenges do first-time home buyers face in securing a mortgage and their best mortgage options?
It right now their
And
biggest challenge
I would
is
say, and I didn't mean it. I didn't mean to interrupt. I apologize deeply for that. But the unique challenges that where I'm coming from is in the middle of the rate challenge that we're in the
mhm.
home price where we are currently. That's what I'm saying.
Um, Basically, it's affordability. I mean, it all boils down to, if they were looking 2 years ago or and they're getting back in the market, they're like, wow, you know, rates have doubled and the house price is a lot more as well. So, basic affordability is the number one thing for a first time home buyer. But it's they're handling those challenges like any other group. They're going out further counties. Um, they're getting gifts. You remember when we talked about their family members are really stepping up and helping people get in houses. But so
Yeah.
far right now, I mean, by far, it's affordability and then inventory. And
Right.
keep in mind that like if somebody's sitting in the Midwest and they're sitting there taking 100 loans applications a day and people are moving in the Midwest and they're all affordable houses where rates are less important on a 250,000 or $300,000 house than they are a 1.3. it so it, that's for our area is what I'm seeing the most.
Right. And that's really what we can speak to specifically, but we can talk generally about the rest of the country. Hi, Philip. Hi, Wendy. Hey, so Philip's got like always, he's bringing the good ones. Does credit backed by a property differ for financing than a credit card?
um, does credit I don't do any credit card lending, and it's never been like on my bank side. But the only lending there's a huge difference in all of it. They can charge that crazy interest rate that compounds over time, where mortgage can't. Right. So there are some differences like that, but as far as it's a tough question for me to answer because mine is just I'll only deal with one piece of that. Um, so when credit's backed by a property, you're going to have a lot more Fannie Mae, Freddie Mac rules and all that versus a credit card is just probably Department of Financial Institutions. I mean, you see that if you I think when they do those credit cards, they've got those 25-page long terms and conditions of that credit card. So, um, yeah, but really can't, it's kind of apples and oranges, I guess I'm saying. It's really hard to compare those two because one's you got collateral in a different lending institution.
Got it. Yeah, because that's way over my pay grade.
Me too. I don't know. I'm not sure I answered what he was asking, but
He's asking for when applying for a loan, is what he says here.
um,
So,
yeah, when you're applying for a loan, you'll credit card's probably a half a page of stuff, and you might provide a pay stub or something. But yeah, on an application, we're asking HMDA information, race, past history, past job, stuff like that. So yeah, it's a little bit. It's a pretty good difference.
got it. All right. So here we go to the next question. Going to shift gears. And Rodney, thank you for putting up with me pounding on you with these questions. But this is good going into the new year. This is good stuff. We're going to cover more thoroughly some ideas for, again, the January push next year and the New Year's housing resolutions you might have. So the next one, and I know that we've asked and answered this before, but it's been a little bit in the past, and it's really common even today when I look at in my company, we have an intranet. It's a Facebook page. It's a private thing, and we've got like 1,500 agents in there, and there's these questions flying around constantly, as you can imagine, 1,500 agents, and I still see lots of concern and questions, usually from the newer agents, but for somebody that's just getting started in the process, they might not know the difference. What is the difference between a pre-qualification letter and a pre-approval letter?
Technically, the terms pre-qualification letter mean that you've just spoken to a lender and y'all have talked about numbers and they've given you some information like, yeah, I mean, by what you're saying, it looks like you can go out and look in a $300,000 range, whatever, something like that. An actual, and that's we kind of do in the middle of this, our industry, a pre-approval. A full out pre-approval means that you're basically a bank's commitment to lend. And really you get that about the same time I send a closing package, right? Unless an underwriter's underwritten it, you don't get a true pre-approval letter. And what happens is, like, for most of us, we'll run the credit report. We'll look at income docs. We'll verify the assets. We'll compare it against our desktop underwriting findings, and you can get to where you're about 100% rate on your approval letters or pre-qual
Right.
letters, to where
Right.
they actually go to closing.
Right.
Well, they're really not a pre-approval letter to the letter of the law until you're ready. I mean, you can send it. You can send a pre-approval letter anytime you want to send it, but it pretty much means you're going to be closing. Okay. So that's what I say is, like, when I send a pre-approval letter, it's got to be through my underwriting. I might as well send my closing package at that time. So,
I've never, as many closings as I've had, I've never really thought about that pre-approval letter is coming kind of with the closing package.
yeah, I mean,
Never really thought them.
it's never done until it's done. I mean, that's the thing about it. It's like,
Well, the two things that I see that you not only do you need the inherent information like income and verification of employment, you need all that stuff, but you need, and you have repeatedly told me, you need to have the address. That's important. You got to have the address. And for most lenders, I don't know, I'm sure you guys probably do it too. You do a snapshot coming close to the closing date, right?
right. Like project the closing date. Yeah. With the fees and everything. Yes.
Well, I mean, a snapshot to make sure everything's still as it was in the beginning when they applied.
Yeah, a little bit. Not at the end. Maybe a little bit closer. We just verify it as we go through.
Got
And
it.
right
Got
now,
it.
closings are so fast, anyways. It's like,
Yeah.
I think our average turn time is like 21 or 22 days right now from contract to closing. So, yeah, it's not a lot of time for them to sit around right now. So,
There's one company I won't say their name, but they do a snapshot, and if like something's out of whack, they got questions.
closing. Yeah, I think every company does what's called a soft pull at the, a week or so before closing or a few days. And if the credit cards have gotten ran up, they may update their DUs and stuff like
Right.
that.
And that's what I'm talking about.
Yeah, it occasionally comes up, but most of the time, people understand while we're going through this. Let's just chill on any purchases and things go smooth.
Last thing you want to hear is, "Hey, I got a new car. You can't believe it. Come look at it."
It's fine. I tell my underwriter all the time, I'm like, people do not live by Fannie Mae and Freddie Mac rules. I'm
No.
like, they just don't. I'm
Uh-uh.
like, so, people live their life, transfer money, do things they want to do. It's our job to make that, work in the Fannie Mae environment. It's like, people are people. I mean, they can spend money how they want to. It's
Well, and when you're getting ready to buy a house, I got to tell you, through personal experience, it's you kind of hold off and you've had this, I can't do that. And then once you get into it, it's like, damn, it's exciting. And all of a sudden, I can afford a house, I could buy a house, and I'm getting a car too. It's
yeah. I might as well get all new furniture.
Oh man. So, and okay, here's this one. I like this question. This is good. What are the most significant changes in the mortgage industry in the last decade?
So this is 2013. 2023. So it's 13 and beyond. So the last big thing was Dodd-Frank, obviously. after the
Which
crash.
is for explain it for people like me.
Well, it's a little out of my time frame. It's like
Okay.
2006 or 8 or something like that, where, when the market crashes, you generally see a lot of regulation after a large incident in a market. Like our market crashed because of the crazy lending that was taking place, people buying stuff they couldn't afford, prices went backwards, and then everybody walked away from a bunch of houses.
Bunch of houses.
Yeah. So after an event like that, you'll see a ton of regulation, and that's what come from the Dodd-Frank. That's what created the Dodd-Frank. And Dodd-Frank had a bunch of rules, and some of them very good about making sure the client basically gets what they expect to be getting. You have to disclose it properly. You can't change. Our business was known for changing stuff at the last minute when people couldn't do nothing about it. So that couldn't, that all that went away. People have to see their disclosures and documents 3 days before closing, and
Yes.
they can't add money for no reason. Like if I quoted up front, I have to honor that all the way through,
Got it.
no matter what. I mean, there's some things that can allow it change, like you could get a new property and the whole deal's done, but I can't change my fees once I quote them to you, even if I've made a mistake.
And that was what I was going to ask you. If you've made an error, you're eating it.
Yeah, I've had several customers get free closing calls. I'm like, oh man, I didn't disclose them. I didn't disclose them in time, and I'm like, well, I could, I mean, what do? You just try to, you can't
Yeah, I
charge.
get it.
I
My
mean,
favorite, my favorite, my favorite thing that happened when I don't even know when it started. I remember everybody was complaining back in the 20 whatever it was, early 2010s, when that TRID law came in, because nobody understood at first, like, what,
mhm,
whoa, that sounds complicated. It
yes,
did an introduction like that. And it sounded risky. It's like we were so used to, I mean, guys like you and me, we'd have changes up to the last minute, and then closing would try to force it the next day or so,
yeah,
back in the day. And then this TRID thing comes along when it's like, oh man, there's no more sliding into home. That's
mhm,
over. And what I learned, and it only took me like 2 closings to figure this out, was with the TRID law, all the questions have been asked, or the opportunity have been asked and answered. I mean, you send out a document, somebody signs it, which implies they've read it and understood it. That's what the signature is supposed to mean. But boy, going into closings after that got figured out, that changed the entire tension in the room for closings. That TRID
yeah.
law.
I love that change. I love that
Mm,
change, and honestly, it's probably the best change out of all of them. Some of the changes were awful that I don't like, kind of oversight stuff and things like that. But yeah, that change right there was much needed, and
mm.
it is really good. It's really easy for the lenders to deliver this. I mean, it's been a really good change. Yeah, I love that piece of it. And
Yeah.
hey, I'll tell you, you mentioned that it was stressful for the whole industry. It was stressful for the title companies. It was stressful for the customers. It was stressful for the realtors, the mortgage companies. And now we all know it has to be out 3 days, and it's the greatest thing ever because the end of the month now is a lot smoother because we know you have to get it out earlier. So
Yeah.
it's like you
Well, I
know,
remember the discussions I was having with lenders back in the day, and this goes back into our history a long time. And you and I have always dealt with the TRID law. That's always been the case.
Mhm.
But before that, what they were panicking about, and I understand it, is for the lender, all of a sudden, if you are used to 30-day closes, plus or minus, they're thinking 3 days, that's 10%. You mean I got to up my speed 10%?
Mhm.
Or it's
Yes.
not happening? Because if it's not on time, it's not happening.
Right. Yeah. I mean, but that's the good thing about it is, they made it in a way. And I apologize. That's outside the 10 years or whatever.
Well,
But they made it in such a way where you can meet it, okay, I can meet it and it can change. Like I can give you a closing disclosure and I start the clock, so to speak, with that 3 day
Yes.
thing. And
Yes.
let's say you change insurance company or something like that, or taxes are a little bit different than what the title person said. All that is just changed, and they can sign it at closing. But what it does, it allows us to be flexible, but it doesn't allow anybody to overcharge the customer for
Right.
stuff that wasn't disclosed up front.
Yeah, I just call that balance in the documentation. All right, so we went on a little long about that, but I'm telling you, that's how much I love it. That it's good for everybody. So whoever came up with that. And so here's my final question on picking the brain of the really smart lender, and it is: what are some lesser known mortgage options or programs that home buyers I'm going to say should consider, but don't know about?
Well, I kind of want to say VA, but
Hmm.
I'm going to leave that one off because it's kind of too obvious. Uh, but I will say what I refer to as my millennial loan. It's a high LTV, a 97% conventional, and why I call it that is because I feel like millennials have good credit and not a lot of down payment. And the 97
Mm.
conventional, as long as they're within income limits, they can buy and get a reduced mortgage insurance rate on their kind of like FHA or RD. They get a little bit cheaper mortgage insurance rate
Hmm.
and makes it a little bit more affordable. And the down payment's only 3% plus it's conventional, meaning
And
you
what do
could
you
rent it
call
out
this?
later.
Is there a
It's
name for this?
I want to say
Millennial
it's
loan. I like.
home ready or home possible is
Got it.
is the correct terms. They used to be called something else, but it's home ready and home possible is the name
Okay.
of the loan now. Other than that, I would consider home equity lines of credit. People don't, and I know interest rates are up right now, but they haven't always been this high. So home equity line of credit is always a good option. And you'd be surprised at how many times somebody comes to me and says, "Well, I may even sell this thing in like 9 months or something or whatever." And I'm
Right.
like, "Well, hey, let's look at this. Let's do a home equity line of credit, and you don't have any closing cost on it. And who cares what your rate is for 8 months? Like, you're going to be just paying interest only, and you're going to sell it or whatever." So I just look at some. I'd say those two are some of my biggest
Okay.
that
All
people
right.
people overlook the home equity line a lot of times when it's a feasible option.
And you would use that for what?
I use it for mostly for purchases and refinances. I'll give you a good example.
Okay.
It wasn't a good time for somebody to refinance right now. They had a really good rate on their first,
Okay.
but unfortunately, family was going through a divorce and they needed to pay the spouse off with a house.
Oh yeah.
So I kept the good rate. Their 3.5 or whatever it was, 3% rate, and did a home equity line of credit for them. And that way, one spouse could pay off the other spouse, and then still have that good. They only have half their money at a higher interest rate versus all their money on a traditional refinance.
Interesting. Interesting. I was just kind of sorry. I didn't mean to go silent on you. We got some good questions in there. So we have a member of the population speaks up. Hi, Brian. How are you? Glad you're joining us. I'm going to throw some of these up there. We're going to read through them. We're going to be moving on to. Let me do something real quick. I want to thank you for letting me pick your brain on that, Rodney. It's important. And I think for the things that people don't think about, there's more options. I guess what I'm saying is there's more options than people realize. That's really what the deal is. So moving on to the next topic. The Federal Reserve could achieve a soft landing after all, and I think we might have a professor on the line that could help us, maybe a lot in this confirmation or this conversation. So in terms of the Federal Reserve reaching a soft landing, here's what they're after.
Goodness. Yeah.
I couldn't resist that.
Yeah.
In terms of the soft landing, I think I'm going to pull up these questions and see what we've got. We may not be able to cover these. We'll just have to see. Reflecting on the Federal Reserve funds rate during the 80s and 90s, we observed the fixed 30-year and 10-year Treasury notes sustain elevated levels for approximately a decade. The term high is, of course, relative in this context.
I'll jump in. I am with the greater majority thinking that the rates are going to come down. Okay. Now,
Yeah.
I don't think that, like, I think some people are already projecting cuts in January. I don't see that. But however, I think possibly by the end of the first quarter, we could potentially see something, especially if these numbers we've seen continue to go down. But it's when they talk, all this is it's the for them to come down, that would be a soft part of the soft landing, right?
Yes. Yes.
So while they're talking about a soft landing, it's, although I think it's reasonable and probably the most likely outcome, but to think about it like this, they want mortgage interest rates to go down. They want the stock market to continue to do good. They
Yeah.
want unemployment to remain or get worse. I mean, they don't want the job market going crazy, or
Right.
else that's going to hurt inflation.
Yeah.
And then what else? And then they're wanting to, and then try to lower rates at the same time without sending us in. They're trying to do all of this without sending us into a bad spot by cutting it too much over the last year or two.
Yeah. It's
So
a
I'm
hell
like,
of a balancing act. It's a hell of a balancing act.
yeah, I'm just like, I don't think we're going to achieve all of that. But if we achieve 3 out of 4 or 4 out of 5, whatever it is, it'll be highly successful with them navigating this market. Because I didn't see how they could they have improved affordability, right? Affordability has gotten a little bit better as the rates have dropped, the home prices are not going up crazy. So it's actually working a little bit. So
It is, and I'm gonna jump ahead to what my expectation is, and I want to warn you, I'm surely not an economist, but I deal with big dollars on a regular basis. That's what real estate is, and you have to monitor expectations and how the market responds. And here's what I mean by that. I'm going to jump ahead to, he's asking for a projection, which we've said for almost a year now. A projection is as good as the paper it's written on, which it may not turn out, but people are going to still try to do it. And in terms of the percentage rates, I think that 6.5 is possible. I think that that's absolutely possible within this before the end of next year. That's what I believe. 5%. I don't see 5% at all in the high fives, but 6.5, I do actually see that. But what Rodney and I have been talking about, and I absolutely have great faith in it, is the idea that people's attitudes fuels the market. Now, there's going to be some things that if it just happens, the market's going to change. That causes disruption. But in this particular case, when we're talking about, and I'm going to do this again, if this actually happens, there's going to be a lot of happy people out there, and investments are going to get good, and rates are going to come down, and it's going to be happy days. We've got they're actually talking about, and this is really a common conversation. I heard it just this morning on one of the business channels, is that they believe that a soft landing is possible, that we're in a state of disinflation, which means it's still going up, but slower than before. It's not negative, it's just going up slower, which, call me the housing market. That's what's been going on. But we're now at 3.1%. What's the target rate? It's 2%. 3.1. You show me when that CPI, I guess is what it probably was, or the PPI was like way different. But the if that 3.1 slips into a 2 point something, it's going to be this. Wow. you know, I can see it from here, you know. And again, we've got people that are, here's my point. We've got people that are starting to believe that it can actually happen. And I have to think that Jerry's pretty happy with himself, you know.
Go ahead, finish up.
No, well, and I'll put a pin in this. We're going to get, I think we confirmed, we're going to get the news tomorrow for the next addressing the rates, right?
Right. Yes. I think at noon or something tomorrow, they're expected to not raise or not lower, right? To stay as is. Yeah. A big meeting to do nothing. That's how our government works. They get to have a meeting and do nothing.
In this case, I'll take it. You know, I'll take it. I had a thought there.
Well, I agree with you. While your thought comes back, the soft landings, I think, definitely in touch. It's just like I'm just hoping some of the important factors out of it, you know, or 3 out of the 4, you know, because most of it's going to have to happen for us to achieve that anyways. And I mean, we've been dragging along this bottom forever now. So it's like for it to be hard or to be terrible from this point forward, I just don't see it. Because we're, you know, honestly, Andy, we're closer to a 6.75, 6.5 rate right now. I mean, you can, not everybody can get it, but with really good credit, you can get it under 7.
See, I'm guilty that I tend to see the big marquee stuff, you know, like Mortgage News Daily, which is, I guess that's probably the average. It's showing 7.9 right now, 7.09. So, yeah. And there you go. So that means that my 6.5 could be good.
Yeah, I mean, you could hit it by the end of the day and not even know it.
So there's 2 other things that Brian was asking about, and that is, what does it mean for us? I believe, you know, that's one of the questions built into this thing. So if we do have a soft landing, there's going to be lower interest rates. We've just been talking at death, but that's going to be a big deal. And then there's going to be they're expecting, and I'm reading from CNBC, there would be an expected rally in the stocks and bonds, but it would be unlikely to be sustained, is what they're saying. Equity markets are already pricing in the good news for tomorrow, and we've talked about that. We've figured out what that means.
Yeah, you can't wait for good news to be. If you wait for good news, you're late. Like
you're already late. Yeah. And then and it says here, and this is again prognostication, good as the paper it's written on. Markets are now even showing roughly a 13% chance, which is low, of a rate cut as early as January, according to UBS note. Now, it's my opinion that people that are calling for a rate cut don't understand what's actually going on. Not that I have a deep understanding, but if we have a rate cut, that means that Jerry and the gang are trying to adjust for something that's trying to go off the rails.
Right. If any kind of rate cut would be to spur the economy,
and that means we're going to have a glancing blow, is what it sounds like to me.
And let's say if they, you know, if we hit in 6 months we hit 2.6 or 2.4, 2.1 on the inflation, and then they see it's going to be, and we're on a slide, right? So it's not like it's going to stop immediately. So if we're on a slide with that, at some point in time, they can start raising to because the time it takes to affect it, right? So if
Yeah.
we're on a slide and they raised it in March to help, so the slide didn't go further, right?
Yeah. Yeah.
That's kind of what but I don't see the job market is just, I don't see us ever going back to where there's all these people can't find jobs. I just don't see it. I
Yeah.
just
I don't
think
need
there's too many people coming in in our country for our job market to be that bad.
Yeah. And when it comes to the job market, just so happens I was researching that just before the show today. And so the economy added 199,000 jobs, which is that's decent, right? That's decent. The unemployment rate dropped to from 3.9 to 3.7, indicating a strong job market, meaning more people are working. Yay.
Mm-hmm.
Sector performance. Now, one of the things, and this is not in this research, but I have been hearing that part of the job growth, a big part of it was government. I don't know how to confirm that, but there was a lot of government jobs coming back. And the automobile strike people had made an impact to some degree. There's wage growth, which is really healthy. People are, with inflation, you got to make a little more money. Thank you, employers.
Yeah.
But the balance on this thing, and that's why when we talk about tap dancing on the head of a pin, it's the labor market is also cooling down, so it's less tight, what they call less tight than it was. I mean, so it looks like we're in good shape, and I am a Brian Spur fan. Listen, read this. All these headlines have refueled buyer confidence. We just need rates to hit a point that shifts the mindset of sellers to release inventory into the market. I tell you what, that summarizes the last 9 months of our live stream.
It does. Thanks, Brian. You just said that in one sentence, what took us
Just
3 years to talk about.
I'm telling you, that is exactly
Yeah,
right.
And I'm stuck on that study that we talked about. It was like 85% said that if the rates got to the high fives, 5.75 is what I think was the mark, that they would jump back into the market. So I think it's, in the fives, in the mid to high fives, we're going to see an onslaught of all of our pent up demand. He talks about the empty nesters. I mean, I've almost become an empty nester waiting on a good opportunity to sell my house in this area. Think about that. Like,
yeah,
3 or 4 years ago, it wasn't a good time to sell, and then all this COVID stuff, you couldn't sell. You couldn't sell or buy and sell. You had to just go buy without selling yours, with no contingencies and things like that, no inspections and all that nonsense. So, yeah, it's I think he's right on the money where it's hit. I think it's going to be in the fives before that happens, but when it does, it'll be, I think, our market. I'm actually looking forward to it, because I'm looking forward, because that's my client, is all of our past clients, the move up buyers, the people local here, things like that, and selling and buying, in our local area. That's
and we're going to find, and we've already seen where when we were dancing around 8%, I think we did hit it a couple of times, but when we, the past few months, and it would drop down to 7.5. Remember, we talked about this before. People recover from, it's not 7.5. I can live with that because it was 8. I mean,
right.
Things are looking good.
The whole 8%, when it ticked up to hit 8%, it made the 7% look
really good.
It's like, well, 7 wasn't so bad, or 6.5 wasn't so bad. Now I'm staring at, the big infinity sign on an interest rate. So So the consumer confidence got a lot better just because the rates got worse really quick.
Yeah.
And
And
now they're coming down. So, but that study was actually done before the rates hit 8%. So I think y'all are right. I mean, it could have moved that number up to closer to 6.25. I mean, it. But like y'all talking about, as rates stay stable or decline a little bit, that in and of itself will produce confidence. Unlike
it
what
will.
it has been, just skyrocketing.
Yeah, yeah. And when I talk about stable, what I mean is just nothing abrupt. Don't take me from 7.25, and I'm making this stuff up, but don't go from 7.25 to 6.5, because all of a sudden people are going to go, wait, I could do that again. They're going to wait for the next big drop.
People are always going to wait. I mean, it don't matter. I mean,
Yeah.
I've had, I've had people give them 2.1. They're like, I'm waiting for 1.9. And I'm like, okay, yeah.
Can we
I
do
mean,
the math on that?
I mean, so you're always going to have wait. So
Yeah.
it's good, but
Oh,
that's funny you say that.
It's what a great way to end this show. We're going to have to wait on the housing affordability. We'll do that as our last show of the year. I think that'll be the last show.
Yeah. It's not like we haven't done that one once.
Yeah, but the least we're gonna do a summary on 2023 and at least affordability on that. So I want to see something. Want to bring Brian up here in our market in Connecticut. Hey, my first wife's from Connecticut. I know the area well. We have
I
empty
think my
nesters.
third wife from Connecticut. What's going on up there?
Sitting in 10,000 square. Have no motivation to re-enter the market.
Can you pull that back up in there? Yeah.
Yep.
There's
yeah. Absolutely. Yeah. Yep.
Yeah, I'm agree. I mean, honestly, Brian, it's kind of like what I am. I got a junior in high school, a junior in college, and I'm like, is the market going to be, if I wanted to sell and buy right now, is getting close to an empty nester. I guess I'm not yet, but that's exactly what I've been thinking about. Is like, I don't need such a big house. I want to get a little bit smaller house and a nice outdoor area, Andy, where I can take my shirt off in Tennessee and go out there and get sunburnt, like the hillbilly I am,
Oh man, well, what a fun day. So we're gonna save our last topic for next week, and I don't know. We'll have to look at the calendar. What day is Christmas? That's a Monday, isn't it? 25th.
I probably won't do the show on Christmas, but
okay, good. That's good. Hey, Brian, thank you. Philip, thank you. Wendy, Angie, I know you're going to be dropping by. I just know you will. So we're saying hi to you now. That was really fun. Thank you for all the participation. Rodney, you are a trooper, man. Thanks for answering all those questions.
Man, you're awful nice to me. I appreciate it.
I tell you what, we're going to leave you on this note. So we'll everybody, we'll see you next week. See you now.
All right, see y'all.
Bye.